Welcome to Wall Street Weekly.
Glad to be here.
So, this week, the United States government quietly crossed a frankly terrifying milestone.
Yeah, $40 trillion in national debt.
40 trillion. And almost simultaneously, we saw Walmart, which is basically the ultimate bellwether of the everyday American consumer, suffer its worst single day in 4 years.
Right. It was a brutal week.
Today, we are really diving deep into what happens when this unstoppable force of sovereign debt meets, an immovable, completely exhausted consumer.
It's the ultimate financial tug of war right now. I mean, we've got this massive stack of market data covering the trading week of August 17th to August 21st, 2026, and the overarching theme is just undeniable.
Which is what exactly?
Well, on one side, you have corporate earnings that are surprisingly, remarkably resilient, highly fragmented but resilient. But on the other side, you have the crushing gravitational pull of historic government debt yields dragging down all these asset valuations.
Exactly. And our mission today is to unpack this really complex macroeconomic environment for you. We're going to look at the massive tech and AI sell-off, the Federal Reserve's internal family feud.
That was a wild one.
Yeah, and a highly complex intervention by the U.S. Treasury to save the bond market. Plus, a geopolitical risk premium that is just sending oil and gold surging.
So if you're trying to figure out how these massive institutional capital flows affect your portfolio and why multi-week equity winning streaks just violently snapped this week, you are definitely in the right place.
Let's start by framing the damage. Because despite a decent relief rally on Friday, the major equity benchmarks universally closed this 5-day period in the red.
Yeah, the S&P 500 dropped nearly a percent, negative 0.91% to be exact.
And the tech-heavy Nasdaq bore the brunt of it.
Oh, absolutely, shedding over 1.7%. The Dow Jones showed a little more resilience, but still closed down slightly at negative 0.34%, and the small-cap Russell 2000 contracted by 1.3%.
But those headline numbers, they only tell a fraction of the story.
Right, because to understand why stocks fell, we have to leave the stock market entirely and look at the bond market.
Because right now, bonds are basically dictating the terms of engagement for everything else.
Exactly.
Okay, so let's unpack this. We have to talk about the $40 trillion elephant in the room. The U.S. national debt officially breached $40 trillion this week.
And the immediate reaction in the Treasury market was just this severe, persistent climb in yields across the entire curve.
Right. The 10-year Treasury bond, which is, the foundational risk-free rate for the entire global economy, it closed the week yielding 4.738%. Up 0.30%.
But the 2-year Treasury jumped even more aggressively. It went up over 1.2% in just 5 days, closing at 4.234.
And that differential movement is crucial, isn't it?
It is. It resulted in a massive flattening shift in what we called the 10-to-2 yield spread. The spread ended the week at 0.504, which is a massive 7% weekly change.
Now, the curve isn't inverted right now, but this flattening is a huge signal.
Right. It tells us that short-term rate expectations are adjusting violently upward. Investors are demanding higher premiums right now, today.
So they're compressing that extra compensation they usually demand for holding longer duration debt.
Precisely.
So what is actually driving this anxiety? I mean, 40 trillion is a massive number, obviously, but why did the market suddenly panic this specific week?
It comes down to supply and demand, honestly, and the realization that the supply of government paper is essentially infinite at this point.
Just nonstop printing.
Right. Institutional bond vigilantes are looking at that $40 trillion figure, and they are demanding higher compensation to absorb the relentless supply of new bonds being issued just to fund the government.
And this anxiety pushed long-term yields toward multi-year peaks, right? On Tuesday, I saw the 30-year Treasury bond touched a staggering 5.32%.
Yeah, that is the highest level we have seen since 2007. It's historic.
Here's where it gets really interesting for anyone holding stocks, though. There is a mechanical relationship between that 30-year yield and the stock market.
Oh, absolutely. When the 30-year yield breaks above 5.3%, it acts like a tripwire for massive institutional algorithms.
Think about it from the perspective of, like, a pension fund manager. Your whole job is to generate a reliable return.
Right. And if you can suddenly get a guaranteed, risk-free, non-volatile return of 5.3% from the United States government for the next 30 years.
The appeal of holding dividend-yielding equities just plummets.
Exactly, because those carry the risk of capital loss. The risk-free rate becomes a highly attractive alternative, and that triggers algorithmic selling in the equity markets.
Capital flows out of stocks and straight into bonds.
Yeah. But the bond market volatility wasn't just driven by the debt number. We also got the July Federal Open Market Committee meeting minutes on Wednesday.
Oh, the FOMC minutes.
Yeah.
And these revealed that the central bank is deeply, deeply divided right now.
It was a 9-3 vote split. To put that in historical context, that is the most divided hawkish dissent the central bank has registered in a decade.
We had 3 regional Fed presidents actively dissenting in favor of an immediate interest rate hike. Not a pause, a hike.
Right. And several non-voting members expressed acute concerns that rates must be raised further if inflation fails to cool toward that mandated 2% target.
Now, Fed Chair Kevin Warsh tried to downplay it, right? He called it a good family fight.
He did. But for market participants reading those minutes, it felt less like a family disagreement and more like a definitive slamming of the door on any hopes for near-term interest rate cuts.
To really grasp why this matters, we have to look at the mechanism of how the Fed actually cools an economy.
Right. Their primary tool is the federal funds rate. It's essentially the cost for banks to borrow money overnight.
And when the Fed keeps that rate high, that cost ripples through the entire system. It makes borrowing money expensive for everyone.
And the theory is if borrowing is prohibitively expensive, people stop taking out loans to buy houses or cars or to expand their businesses.
Demand falls.
Yeah.
And prices eventually have to come down to meet that lower demand.
Exactly. What these minutes showed us is that 3 members of the Fed look at the current economy and believe that demand is still too high and borrowing needs to be made even harder immediately.
So what does this actually mean for you, the consumer, and for the broader economy heading into September and October of 2026?
It means we are looking at a sustained period of expensive capital. For the everyday consumer, it basically guarantees that the housing and auto markets will remain effectively frozen.
People simply balk at taking on multi-year financing at these elevated rates.
Yeah, you just can't stomach it. And for businesses, CFOs are going to be tightening their belts significantly. They're revising their fourth quarter capital expenditure models because a larger portion of their revenue has to go towards servicing their existing debt.
But conversely, if you are a saver with cash parked in short-term instruments or money market funds, you are going to continue enjoying highly attractive low-risk yields.
True. So we have this environment of surging yields, hawkish central bankers, and this mountain of national debt. The bond market is starting to crack under the pressure.
And then, on Wednesday, Treasury Secretary Scott Bessent steps up to the podium and announces a massive intervention.
Yeah, he unveils an expansion of the U.S. Treasury's Liquidity Support Debt Repurchase Program.
This was a pivotal moment in the week. Effective September 9th through November 4th, 2026, the Treasury is doubling its buyback program for longer-dated securities.
Right, taking it from $2 billion to at least $4 billion per operation.
Okay, wait. I need to stop you there because this sounds incredibly abstract.
Yeah.
The government is buying back its own debt. How does this actually work, and why does it calm the market down?
Let's break it down. Imagine you have an asset that you want to sell, let's say a collection of older, slightly less popular bonds. The industry calls this off-the-run government debt.
Okay.
But when you go to the market, nobody has the cash or the desire to buy them. Because there are no buyers, the price of these bonds starts to plummet.
And in the bond market, when the price drops, the interest rate surges.
Exactly. This lack of buyers creates panic, which drives yields even higher.
So the Treasury steps in and says, don't panic. We will be the guaranteed buyer.
Right. It acts a bit like a reverse cash-out refinance. The Treasury uses cash to buy these older bonds at a discount, basically retiring the debt.
By stepping in as a guaranteed buyer with deep pockets, they instantly provide liquidity.
The panic subsides, the price of the bond stabilizes and starts to rise, which inversely pushes their yields down.
But here's the most fascinating part of this intervention, and it's something that isn't talked about enough, I think. The Treasury's $4 billion isn't actually enough to fix the whole market.
No, not at all.
But it triggers a mechanical feedback loop with the massive institutional funds like Vanguard and BlackRock, right?
This is the genius of the operation. These colossal institutional investment funds operate under strict legal prospectuses.
Meaning they have rules they literally have to follow by law.
Right. One of the rules they have to follow is maintaining specific duration targets. This means the average maturity of all the bonds in their portfolio must equal a certain number of years.
So when the Treasury steps in, buys long-dated bonds, and forces those long-term yields down, the mathematical duration of these institutional portfolios automatically shortens.
Because the market value of their long-term holdings just changed.
Precisely. And to fix this imbalance to comply with their own legal mandates, these massive funds are mathematically forced to go into the open market and purchase even more long-term bonds.
So the Treasury drops a $4 billion match, and the market's own rules force the private institutions to provide the rest of the liquidity.
It effectively pushes long-term yields down without the Federal Reserve having to step in and restart traditional quantitative easing.
It is a brilliant bit of financial engineering. But as we saw, while it stabilized the bond market, that high-yield environment still wreaked absolute havoc on the stock market.
Yeah, let's pivot to equities because the macro pressures forced a violent rotation this week. And the biggest story was the absolute bloodbath in tech and artificial intelligence.
The valuation pullback was massive. The broad technology sector index, the XLK, dropped 3.68% for the week.
But the thematic, hyper-focused indices suffered even worse, didn't they?
Oh, yeah. The AI index fell almost 3%. AI and power infrastructure plunged an astonishing 7.22%. And the PHLX semiconductor index, the SOX, cratered by nearly 7%.
We are talking about market darlings here.
Yeah.
NVIDIA, Micron Technology, Broadcom, companies that have carried the entire market on their backs for the last 2 years, face severe selling pressure.
Yay.
But why? Is the AI boom over?
It's not that the underlying technology is failing. It's a crisis of ROIC, return on invested capital.
Meaning?
Investors and analysts are looking at the hundreds of billions of dollars currently being poured into massive data center infrastructure, and they're starting to ask the hard questions like, when do we see the return on this?
Right. Will this infrastructure spending actually deliver the near-term revenue and earnings growth required to justify the current stock prices?
And this ties directly back to what we were just talking about with the 30-year Treasury yield hitting 5.32%. It's the discount rate.
Exactly. When you value a hyper-growth tech company, you are mostly valuing earnings that are expected to happen 5-10 years in the future.
Right. And to figure out what those future earnings are worth today, you apply a discount rate, which is heavily based on the risk-free rate of return.
If the risk-free rate is low, say 1%, those future earnings look incredibly valuable today.
But as the risk-free rate rises past 4 or 5%, the present value of those future earnings just collapses.
So portfolio managers look at these high beta, high multiple growth names, realize the math has completely changed, and relentlessly lock in their profits. They reduce their exposure to long-duration equity risk.
So if all this capital is fleeing the tech sector, where is it going? Because it didn't just evaporate. We saw a textbook flight to safety in the defensive sectors.
Healthcare was the absolute outperformer. Tracked by the XLV ETF, it surged 4.53% for the week.
Yeah, and this wasn't just a blind rotation. It was supported by robust, idiosyncratic clinical updates across major pharmaceutical giants.
But fundamentally, it was institutional capital seeking recession-resistant earnings. People still need medicine, regardless of what the 30-year yield is doing.
Exactly. Consumer staples also gained over 1.5% as investors aggressively hunted for stable, predictable cash flows.
But there was one massive exception to the defensive rotation. The utilities sector, which is traditionally viewed as the ultimate safe haven, actually fell 3.19%.
Yeah, XLU took a hit.
Why did utilities fail to protect investors this week?
It's purely yield-driven. People typically buy utility stocks not for explosive growth, but as bond proxies. They want the high, reliable dividend yields.
However, when benchmark treasury rates climb as aggressively as they did this week, the math changes.
Right. Why take on the equity risk of holding a utility stock for a 3 or 4% dividend when you can get a completely risk-free 5% return in a government bond?
The relative attractiveness of utilities is completely negated in a surging yield environment.
That makes perfect sense. Now, let's talk about market capitalization, because the pressure also created a stark divergence between the big players and the smaller companies.
Yeah, the Russell 1000, which tracks large caps, fell less than 1%, down 0.88%. But the Russell 2000, tracking small caps, got hit substantially harder, down 1.30%.
Right.
Why are small caps so uniquely vulnerable right now?
It is deeply structural, and it comes down to how these companies finance their operations. Large cap companies typically have the leverage and credit ratings to lock in long-term fixed-rate corporate bonds.
Many of them locked in incredibly low rates years ago and are largely shielded from the current rate hikes.
Exactly. Small cap companies, on the other hand, have a significantly higher concentration of floating rate debt on their balance sheets.
So as short-term rates rise, like we saw with the 2-year Treasury jumping to 4.2% this week, their interest payments automatically go up.
Exactly. Their debt servicing costs skyrocket in real time, which directly compresses their profit margins.
Furthermore, the Russell 2000 is heavily weighted toward rate-sensitive regional financial institutions.
Right, and when the yield curve flattens like it did this week, the traditional banking model of borrowing short and lending long becomes much less profitable, dragging down the entire index.
It's a tough environment for the little guy. But interestingly, mid-cap equities showed remarkable resilience. The Russell Mid-Cap 800 index fell only 0.70%.
It seems they found the sweet spot large enough to have stable financing, but with balanced exposure to industrials and value-oriented sectors that weathered the tech sell-off better than the heavily concentrated mega-cap indices.
That's spot on. Now, if we move beyond sector allocations and look at the microeconomic data, this week provided a masterclass in consumer bifurcation.
We had a massive slate of retail corporate earnings, and it painted a very clear picture of the winners and losers in an inflation-weary economy.
Let's start with the winners. Target had a phenomenal quarter. They crushed expectations with $26.54 billion in revenue.
Yeah.
And the standout metric was a 3.8% increase in same-store traffic, largely driven by an 8.7% surge in digital sales and same-day delivery.
So Target is winning by offering immediate convenience.
And on the other end of the winning spectrum, you have the off-price retailers dominating. Ross Stores delivered one of the largest retail beats of the season.
Their same-store sales exploded by 10%, driven entirely by an influx of bargain-hunting customer traffic.
TJX Companies, the parent of TJ Maxx and Marshalls, also beat expectations, generating over $15.18 billion in revenue. Their home goods division saw a stellar 7% jump in same-store sales.
The clear takeaway here is that the consumer hasn't stopped spending entirely, but they are actively trading down. They are aggressively hunting for bargains and stretching every dollar.
But when we look at the home improvement sector, it's a completely different story. It highlighted what can only be described as a complete housing freeze.
Yeah, both Home Depot and Lowe's managed to beat bottom-line EPS estimates, but their forward guidance was incredibly grim.
Home Depot reported revenue of $47.86 billion, but same-store sales only rose a meager 1.7%. They explicitly noted that the broader housing market remains completely frozen.
And Lowe's actually missed revenue expectations at $25.96 billion. And the detail they provided was fascinating. Their professional contractor traffic remains steady, likely for essential repairs, but the core do-it-yourself consumer has completely stepped to the sidelines.
People are aggressively pulling back on all major discretionary renovations.
And that goes right back to the bond market and interest rates. High mortgage rates have trapped homeowners in their existing property.
Right. If you have a 3% mortgage, you're not selling your house to buy a new one at 7%.
Exactly. And without that housing turnover, people moving into new homes and deciding to redo the kitchen or the bathroom, the primary driver of home improvement spending is just dead.
But the most consequential data point of the week, without question, came on Thursday. We have to talk about the Walmart shock.
This was wild to watch. Walmart reported a staggering $187.94 billion in revenue. Technically, they beat headline estimates.
Yet the stock tumbled an incredible 9.2%. It was their worst single-day drop in 4 years. Why did the market punish them so severely?
Because underneath those massive headline numbers, the core growth engine is stalling. U.S. same-store sales growth slowed dramatically to 2.6%, completely missing the 3.5% target Wall Street was expecting.
Oh, wow.
But more importantly, Walmart issued very soft forward guidance. They effectively warned the market that the low to middle income consumer is completely tapped out.
And Walmart is the ultimate proxy for baseline consumer health. When they signal that inflation-weary shoppers are failing to sustain purchasing volumes, the entire market takes notice.
It implies that the buffer of pandemic savings is gone, credit card limits are maxed, and the reality of cumulative inflation has finally broken the consumer's back.
And these corporate realities were perfectly mirrored by the macroeconomic data we got on Friday. The August S&P Global Purchasing Managers Indices, the PMIs, confirmed that we are operating in a deeply fractured, two-speed economy.
The divergence in this data was stunning. The U.S. manufacturing PMI dropped to 53.2, which is a 5-month low.
Production growth is slowing down because of higher fuel costs and supply chain delays.
But conversely, the services PMI exploded to 56.8, a 20-month high, driven by the fastest pace of new business growth in nearly 2 years.
To visualize this, think of the U.S. economy right now as a tandem bicycle trying to pedal up a steep hill.
Okay, I like this.
The rider in the front represents the manufacturing sector, building physical goods. Today, that rider is absolutely exhausted, pedaling much slower than last month, burdened by high material costs and sluggish demand.
Right.
But the rider in the back represents the services sector, the experiential economy, dining, travel, healthcare. And right now, that rider is overflowing with energy, pedaling incredibly fast.
Because the services rider is pushing so hard, the bicycle is still moving forward up the hill, which is keeping us out of a recession. But because the front rider is dragging, the whole ride feels erratic and unstable.
It's a great way to picture it. Although I will note there was one strange contradiction in the manufacturing data. On Thursday, the Philadelphia Fed Manufacturing Index unexpectedly surged to a 5-year high of 47.4.
Yeah, that absolutely obliterated the consensus estimate of 24.1.
That regional boom is a critical outlier. It indicates massive new order inflows for factories, specifically in the Mid-Atlantic region.
It suggests that while current national output is slowing down today, the pipeline for future supply chain surges in September and October remains highly active.
And that severely complicates the Federal Reserve's inflation calculus. Do you cut rates because national manufacturing is slowing, or hold them high because the Mid-Atlantic is flashing red-hot future demand?
It's a nightmare for the Fed, and their nightmare gets even worse when we turn our attention to the international forces driving the commodity markets, because those are the primary vectors exacerbating these inflation fears.
The broad commodity complex delivered strong, positive momentum, advancing 2.42% for the week. But the most critical movement occurred within the energy sector, which climbed over 3.28%.
We observed a relentless, steady climb in the price of crude oil. ICE Brent crude, the global benchmark, rose nearly 4% to close at $94.39 per barrel.
West Texas Intermediate, the U.S. domestic benchmark, rose over 3% to $87.06. Even natural gas saw strong gains.
The catalysts for this energy surge are almost entirely geopolitical. Global crude prices are currently factoring in a massive risk premium due to the escalating conflict with Iran.
We saw the U.S. administration issue new economic blockade threats and targeted sanctions against Iran and its trade partners this week.
And that rhetoric isn't happening in a vacuum. It is combined with persistent physical shipping disruptions and bottlenecks in the Strait of Hormuz. That is the world's most critical transit choke point for oil.
Anytime there's friction there, oil futures are forced higher.
Furthermore, the data indicates a sharp year-over-year drop in global refined product trade. We are talking about critical fuels like diesel and jet fuel. So global supply is tightening precisely as winter demand forecasting begins. It is a highly inflationary setup.
Parallel to the energy surge, we witnessed a truly historic breakout in precious metals. The gold index jumped 4.63%, surging past the psychological and technical barrier of $4,600 per ounce. That is a monumental move.
It is, and the drivers are multifaceted. First, you have raw safe haven demand because of the geopolitical uncertainty in the Middle East.
Right.
Second, the extreme volatility we discussed in government bond yields has pushed institutional capital into non-fiat, non-yielding hard assets. If bonds are wildly unpredictable, gold suddenly looks much more stable.
Third, despite the high interest rate environment, we actually observed a slight weakening of the U.S. dollar against a basket of international currencies.
But the biggest driver goes right back to where we started this conversation, the $40 trillion national debt.
Precisely. This gold rally is a direct indictment of long-term fiscal debt expansion. Sovereign wealth funds and massive institutional allocators are looking at that $40 trillion milestone, and they are hoarding gold as a hedge.
They believe that to service such a colossal debt load, the government will inevitably have to mathematically debase the fiat currency. Gold is their protection against that debasement.
Rounding out the commodities, agriculture posted a robust 2.36% gain, primarily driven by intensifying El Niño weather risks threatening global crop yields, plus elevated transport and fertilizer costs.
Meanwhile, industrial base metals remained essentially flat at 0.10%. Investors are caught between the long-term structural demand needed for the global energy transition and the near-term manufacturing headwinds we saw in the PMI data.
Now, to fully contextualize how all these macro themes interacted, let's walk through the chronology of the trading week.
Okay, yeah, let's do it.
Monday opened with a mixed close. We had that strong Empire State Manufacturing survey in New York, which briefly boosted sentiment but instantly pushed Treasury yields higher, acting as a headwind.
And internationally, Brent crude spiked above $90 on the initial shipping constraints, setting a stagflationary tone right out the gate.
Then Tuesday brought the devastation. This was the week's most aggressive liquidation event.
We saw the severe sell-off in tech and AI, dragging the Nasdaq down heavily in a single day. The U.S. 30-year yield hit 5.32%, and it wasn't just here. European and Asian sovereign yields hit multi-year highs as inflation fears went truly global.
That panic bled directly into Wednesday. Asian markets opened in a freefall. South Korea's KOSPI plunged 5.54%, and Japan's Nikkei dropped over 2.6% overnight.
But then the U.S. intraday reversal happened. We got the hawkish July FOMC minutes, which ironically calmed the market because it provided certainty about the Fed's stance.
But more importantly, Secretary Bessent announced the expanded Treasury buyback program, successfully halting the bleeding in the bond market.
Thursday, however, brought renewed pain with the dual shock of Walmart's disastrous earnings report and the official confirmation of the $40 trillion debt milestone.
The realization that the consumer is tapped out while sovereign debt is insurmountable sent the Dow plummeting 703 points.
Finally, Friday offered a modest relief rally as traders digested the mixed PMI data and squared their books ahead of the upcoming Jackson Hole Symposium.
And notably, risk assets caught a bid in the alternative space, with Bitcoin rallying over past $77,500 amid minor dollar weakness.
From a quantitative perspective, analyzing the volatility this week presents a fascinating study in market structure. Over the 5-day period, the S&P 500 rate of change was decidedly negative, at negative 1.43%.
In a traditional market environment, a drop of that magnitude would trigger a massive spike in the VIX, the volatility index that measures fear in the market.
But that didn't happen. We saw an inverse relationship. The VIX actually ended the week down slightly at 15.3.
How is it possible that stocks were dropping, but the primary fear metric was also dropping?
It tells us an incredible amount about institutional positioning. It suggests that the big players were already heavily hedged prior to the sell-off.
The market's decline wasn't a panicked, chaotic liquidation. It was an orderly, systematic de-risking.
Everyone knew the risks, prepared for them, and executed their selling algorithms cleanly.
We saw a confirmation of that cooling uncertainty in the bond market too, right? The MOVE index, which measures Treasury market volatility, dropped almost 3% to 73.40.
Exactly. The Treasury's $4 billion buyback announcement acted as a massive volatility dampener. It proved that while yields remain high, the erratic, unpredictable swings in fixed income could be successfully suppressed by the Treasury's intervention.
And if we look at the Shiller PE ratio, which measures valuation relative to a 10-year inflation-adjusted earnings base, it exhibited a perfect one-to-one positive correlation with the S&P 500. It dropped 0.92% to close at 41.96.
Which proves that this week's equity drawdown was purely a multiple compression event. The stocks didn't fall because underlying earnings collapsed. They fell because the discount rate applied to those earnings went up.
It was entirely mathematically driven by the bond market.
Okay, so that is the post-mortem of a chaotic week. But as investors, we need to know what's coming next. Let's project forward and look at the expectations for the upcoming trading week, spanning August 24th to August 28th, 2026.
The macroeconomic calendar is incredibly dense. Tuesday kicks off with the Conference Board's Consumer Confidence Index, looking for a consensus estimate of 90.3 alongside new home sales for July, expecting an annualized pace of 620,000 units.
Everyone is going to be scrutinizing these metrics for further evidence of the consumer slowdown highlighted by Walmart and Home Depot.
But the real fulcrum of the week arrives on Wednesday with the release of the critical July core personal consumption expenditures, the PCE price index.
This is the Federal Reserve's preferred inflation gauge. The year-over-year consensus is projecting a sticky 3.3%, with a month-over-month increase of 0.2%.
Also on Wednesday, we get the Q2 GDP revision, expected at 1.5%, and July durable goods orders at 0.5%.
The strategic guidance here is unambiguous. If that core PCE reading prints above the 3.3% consensus, it will unequivocally empower the hawkish Fed officials who demanded immediate rate hikes.
An upside inflation surprise will trigger a violent repricing of the short-term yield curve and exert immediate, severe downward pressure on equity valuations all over again.
And the timing is critical, because Thursday marks the commencement of the annual Jackson Hole Economic Symposium.
This is the global gathering of central bankers, the premier venue for telegraphing long-term monetary policy shifts.
Institutional investors will parse every single syllable of Chairman Warsh's keynote address. They want to know how the Fed plans to navigate this collision between sticky inflation, massive government deficits, and bond market volatility.
On a corporate front, next week represents the ultimate momentum test for artificial intelligence and the broader technology sector. Wednesday brings the earnings release of NVIDIA.
This is the undisputed bellwether for the entire market right now. Analysts are looking for a definitive beat-and-raise quarter driven by hyperscaler infrastructure spending.
The entire market is going to be hyper-focused on the demand trajectory and supply chain integrity for their upcoming Blackwell and Vera Rubin processors.
NVIDIA's report is the ultimate litmus test to justify current tech valuations. If there is any hint of a deceleration in capital expenditure spending from their major clients, it will trigger a sector-wide correction that makes this past week look mild.
Also on Wednesday, CrowdStrike reports earnings. Wall Street expects a 26% year-over-year earnings surge, focusing on new net annual recurring revenue and their premium AI-driven cybersecurity offerings.
Salesforce will also report, giving us a look at Agentforce monetization trends versus next-gen AI platforms.
On Thursday, the software sector continues with Autodesk and Workday, which are critical for gauging enterprise and HR software pipelines amid these tight corporate budgets.
And we also get a secondary retail check on Thursday with earnings from Dollar General and Dollar Tree. In the wake of Walmart's brutal guidance cut, the market is going to rigorously analyze these discount retailers.
They're looking at gross margin expansion, freight cost impacts, tariff exposure, and most importantly, the traffic stability of the lowest income consumers.
Based on this massive convergence of macro data and corporate earnings, the tactical blueprint for the week of August 24th is clear.
First, rigorously monitor sovereign debt yields and the U.S. dollar index impacts on tech and gold. These macroeconomic forces will dictate the baseline performance.
Second, maintain and potentially increase defensive allocations. Use consumer staples like XLP and healthcare as strategic ballast within your portfolio to insulate against the dual threats of consumer exhaustion and sticky inflation prints.
Third, and most importantly, prepare your portfolios for major asymmetric volatility in the technology, XLK, and semiconductor SOX sectors.
The combination of the PCE inflation print, the Jackson Hole Symposium, and NVIDIA's earnings all landing within a 48-hour window guarantees massive price discovery. Ensure your position sizing is conservative and you have strict stop losses established to mitigate downside exposure.
So what does this all mean? If we synthesize the overarching lesson of this entire deep dive, U.S. financial markets are currently caught in a precarious, high-stakes tug-of-war.
We are witnessing resilient, cash-generating corporate earnings battling against the relentless, crushing gravity of historic sovereign debt yields.
As long as the U.S. government must fund $40 trillion in debt at 5% interest, the cost of capital will remain a structural headwind.
It caps the expansion of equity multiples and forces investors to demand absolute, flawless execution from corporate America.
The provocative question you need to ask yourself as you look at your own portfolio is this: how long can the weight of $40 trillion be ignored before the gravity pulls everything back down to earth?
A sobering thought to end on.
If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment or a review wherever you listen to your podcasts, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.